Portfolio risk is more complex than simply averaging the risks of individual stocks. The central insight, pioneered by Harry Markowitz in Modern Portfolio Theory, MPT, is that risk depends heavily on how different assets move in relation to one another. 1. The mathematical components of risk. To measure the risk of a portfolio of two assets, A and B, we need three pieces of data. Weights, W, the percentage of total capital invested in each asset, W_A plus W_B equals 1. Standard deviation, sigma, the individual volatility of each asset. Correlation coefficient, rho, a measure of how A and B move together, ranging from -1, opposite directions, to +1, perfectly synchronized. The portfolio variance formula. The variance of a two-asset portfolio, sigma_p squared, is. To get the portfolio risk, standard deviation, we take the square root. Note, text, cov, RA, RB, equals, sigma_A, sigma_B, rho_ab. 2. Numerical example. Let's measure the risk of a portfolio split 50-50 between a tech stock and a utility stock. Investment in tech, W_A, 0.50. Risk, sigma_A, 20%. Investment in utility, W_B, 0.50. Risk, sigma_B, 10%. Correlation, rho_ab, 0.2. They are slightly related, but not much. Step 1. Calculate the terms. Tech component, W_A squared, sigma_A squared equals 0.5 squared times 0.2 squared equals 0.25 times 0.04 equals math_BF 0.01. Utility component, W_B squared, sigma_B squared equals 0.5 squared times 0.1 squared equals 0.25 times 0.01 equals math_BF 0.0025. Covariance component, 2W_A W_B, sigma_A, sigma_B, rho_AB equals 2, 0.5, 0.5, 0.2, 0.1, 0.2 equals math_BF 0.002. Step 2. Sum to find portfolio variance. Step 3. Find portfolio standard deviation. 3. Economic interpretation, the diversification effect. Notice something remarkable in the example above. The weighted average risk would have been 15%, 0.5 times 20% plus 0.5 times 10%. However, the actual portfolio risk is only 12.04%. Why? Because the correlation, rho, was less than 1. When the tech stock has a bad day, the utility stock might stay flat or go up, cushioning the blow. This is the diversification benefit. Key takeaways. If rho equals +1, risk is just the weighted average. No diversification benefit. If rho equals 0, significant risk reduction. If rho equals -1, you can theoretically create a zero-risk portfolio because the assets perfectly offset each other. 4. Measuring risk in large portfolios, beta, for portfolios with hundreds of stocks, calculating every correlation is impossible. Instead, we use beta, which measures how the portfolio moves relative to the overall market. Systematic risk, measured by beta. It cannot be diversified away. And systematic risk, specific to companies. It is eliminated by holding a diverse portfolio, as shown in our example. Would you like me to explain how to calculate the Sharpe ratio to see if the return you are getting is worth this measured risk?